don't feel you've got to hit a home run on your first purchase. There's nothing wrong with hitting a single and gaining that experience and track record. So if you wait around forever trying to hit a home run, you could have hit 10 or 20 singles by that time.
All right, guys, welcome to another episode of The Report. Today, I got a special guest. I got someone who goes way back. We met back in 2019 when I was first getting my start in real estate investing, and he helped me buy not one, but two multifamily deals. My first ever real estate deal, 11 units in Cincinnati. He's a multifamily broker. He is a partner and owns a brokerage, Sabre Group, out in Cincinnati. And I got my man, JD Schmerge. JD, welcome to the show.
Thanks, Rich. Appreciate you having me on.
Yeah, man. It's been a little bit, but we go freaking way back. Met back in 2019. You helped me close and acquire my first ever commercial real estate deal, 11 units out there in Norwood, still owned today. But that deal got me in the freaking game, man.
Yeah. Pretty sure you found that on LoopNet. Remember that first message like yesterday. Could feel the enthusiasm through that first email and ended up buying it sight unseen. Bold
Yeah.
move.
It's crazy because, like, when I look back at everything since then, that one deal for me at that time was, like, scary for me. It was pushing my comfort zone. I cashed out my 401k. A lot of people told me it was too risky. A lot of people told me not to cash out my 401k. A lot of people told me not to go invest out of state. And I made all the mistakes with that deal. You recommended a property manager. I went a different direction with the initial property manager. It was the wrong one. A few tenants moved out right after closing, and I had to pivot a couple months later to a different property manager. I ultimately ended up going with the McGrath, who you suggested. But I made all the mistakes with that deal, and guess what? It still panned out. It still worked out. We were able to add a lot of value with the property and able to do a cash out refi a couple years later. But the most important piece, I think, for the listeners is that one deal. I didn't know it at the time, but that one deal gave me the confidence to go and do another one, and then the confidence to go do another one. And then ultimately it led to all this. And had I not done that one deal, I don't know if I would be here, standing here right now doing everything that I'm doing.
Yeah, and I think that's the beauty of multifamily in Cincinnati is there is margin for error. With the higher cap rates in the Midwest relative to the coastal markets, you can afford to make some mistakes and still be cash flowing. So
Yeah. And I think that was like, when I look back at my mindset going in, and this is important for anyone listening, that if you're looking to take down your first deal in whatever asset class it is, I think for me, I was really looking for something to where it would underwrite well, it would provide some cash flow, relatively high cap rates. And I think Cincinnati does provide a lot of that. And it's a market where there's, positive employment growth, positive population growth. And so I felt like for the first deal, it was hard to go into that market and make a mistake as long as you were buying it at a good basis there.
yep, absolutely.
Yeah. So then about a year later, you helped me, you brought me another deal off market, Madison, which we actually sold a little while ago. But that same deal, I remember you brought that to me. I knew it was a good deal. I was like, man, the basis was so cheap. And I'm like, okay, like I just got to do it. We locked it up. We figured it out. And that appraiser now is your partner today.
Correct. Classic small town, Cincinnati, Northern Kentucky. Everybody knows everyone. So small town, especially once you've been in the same industry for a number of years. So Sean appraised that one. And
Yeah.
a few years later, we could, by chance, become business partners.
And now you guys are partners. You guys are doing bigger things out there in Cincinnati, which we'll jump into here in a sec. And now you and your wife, Jacqueline, we had dinner last night. You guys invested in our fund. You guys stayed at hotels in Dell last night.
Yeah.
And so it's crazy how it just all goes full circle, man.
Yeah.
Yeah.
It's exciting and was rather spontaneous, but saw you doing big things out here and figured we'd diversify a little bit. And so far, so good.
This game is all about relationships. It's all about people and who you know. Okay, I want to switch gears here. So let's talk about the multifamily front. We've been in a high rate environment for the last 30 months. How has that affected the multifamily, market, especially out there in your markets where you guys are working, Kentucky, Ohio, Cincinnati, all that stuff?
Yeah. Great question. So I was looking back at the last few years of transaction volume, and in Cincinnati, looking at 10 plus unit deals. In 2021, coming out of COVID or somewhat out of COVID, there were about 30 transactions in that size realm. 2022, that dropped to just over 100. 23 was about 90. 2024, there was about 70, 73, 74 transactions in the Cincinnati MSA. So
And what
that's
size
15,
again?
10 plus units
10
in the
plus.
15 county MSA.
That's a lot less than I would think.
Yeah, there's not a lot of transactions to be had. It's a secondary market. There's 160, 170,000 units in Cincinnati. So you figure, 2 or 3% of that is trading every year. So there's not a lot of deals to go around. So when you get those opportunities, you gotta seize them and take advantage when you can.
What are you guys seeing with cap rates out there in Cincinnati? Maybe talk about the cap rates since you kind of got in the game in 2019 till now.
Yeah. So I got in real estate end of 2017, and a 7.5, 8 cap was pretty average at that time. And it seems like shortly after I got into multifamily, that just kept going down and down. And then obviously the pandemic where, rates were at record lows. So now 8 cap is not totally unheard of anymore. I think caps are starting to decompress slowly but surely. I think most of the world thought that we were going to see more rate drops, rate cuts, but it just hasn't happened yet. So I think
How low did the cap rates get? Like, what was some stuff that you saw trading like in the multifamily space in terms of like a
we
low cap
saw,
rate?
especially if it was a value add deal, sub 5 caps. During when rates were 3%, there was still 200 basis point delta between cap rates and interest rates. So to put that in perspective, now you would need 9 caps to make that happen with rates at 7, and there's not really 9 caps
Yeah.
happening yet.
And just to put it out there for the listener, cap rate is essentially a market's opinion of a risk-adjusted return. And so essentially, if a buyers want to pay a lower cap rate, they're basically saying they're willing to accept lower cash flow, in-place cash flow going in, because maybe they think they're going to be able to add a lot of appreciation, or maybe the market is less risky, maybe the asset is less risky. So generally speaking, a high-growth market like let's just say in Southern California or Austin, Texas, is going to trade at a lower cap rate than something like Cincinnati or maybe like an Oklahoma City, where there's a little bit less organic appreciation long term. And so buyers want to pay a little bit more for the asset, accept a little bit less cash flow in a market to where there's more organic appreciation. And so, to what you were saying with the cap rates compressing, the interest rates compressing, especially 2021, I remember, people were getting 2.5% interest only on like larger multifamily lending. And people were just chasing all sorts of assets. And, I think coming off of COVID, the sentiment was, wow, we just went through like a completely like pandemic shutdown and there was no recession. The government just printed all this money. They dropped interest rates. And so there's a lot of people chasing stuff. We sold not too far from Cincy up in Indianapolis. This is a 32 unit building. We had sold it in end of 2021. We'd renovated 50% of the units. This is a C-class product. It had a lot of problems. It was a blue-collar workforce type of property, and the buyer had paid a 3.7 cap rate. And we sold it right before the rates started going up. And that was when I was like, man, this is getting crazy. 3.7 cap rate, C-class 1960 product in a suburb of Indianapolis. And that's when I was like, this is getting crazy.
Yeah, it's not easy to time the market that well, but seems that you did it.
Got lucky there. But, I would say the last 30 months for most operators has been a grind. I think the sentiment since the rates started going up was survive to 25. A lot of people thought we would see some relief in 25. And so be it. I mean, look, we got new presidency. We got, a completely different kind of outlook right now, at least as we go into the next few years. I think there's a lot of things to get excited about. But talk about what you kind of see as you guys look forward in 2025 and maybe 26. What's the advice that you're kind of putting out there for your buyers and also your sellers?
Yeah, so I'd say my advice is don't wait to buy. I think the time that cap rates are going to be a little bit higher is going to be short-lived. And I think maybe the first half of this year might still be a little bit rocky, but I think the economy is going to get rolling again. And I don't see a huge decrease in rates, but I think we'll find a new normal in rates without this uncertainty, and I think transaction volume will pick back up. So unless you're planning to try to flip something in a 12 to 18-month period, I wouldn't recommend waiting because time heals all wounds. Like I said, it's hard to overpay in Cincinnati, and if you're a 5 to 7+ year holder, you're better off buying sooner than later.
Yeah, I agree with that. And I also think that right now there's just not a ton of buyer competition. And I feel like when the news turns around, the Fed continues to cut rates. And once the bad news turns around, I think you're going to see a lot of buyers that were on the sidelines. They're going to jump in. And I think, when that time comes, then it becomes more of a seller's market. And it's going to be harder to be awarded some of these deals. But I feel like right now you are seeing, at least we're seeing deals, especially on the hotel side, to where there's not a lot of buyer competition. So if you can come in and make a run at a property, you can often negotiate some pretty favorable terms. I'm not too afraid of the rates because, we're buying value add product and we're going to be refinancing here in 18, 24 months anyways, where I believe the rate environment will be a little bit cheaper.
Mm-hmm. Yeah. Yeah. I mean, if you can get a deal to pencil now and you're of the thinking that rates are going to come down, what are you waiting for? I mean, if rates are at 3%, they're not going to go any lower. So you've peaked on day one. There's not any upside strictly from an interest rate perspective. So if you can get a deal to pencil now, rates come down, that's just the cherry on top.
30 months ago, before the rates started going up, if someone told you, hey, the rates are going to more than double for 30 months straight, would you have expected a much more, like a bigger crash in the marketplace?
I would have. Cincinnati's pretty resilient, so I'd say we don't have the high highs, but our lows aren't as low either. We're kind of a boring, safe market, if you will. So, 3% rent growth is pretty standard. Now, even during the pandemic, though, like most other cities, there was 15, 20+% rent growth. So,
But, some of those markets like Phoenix led the nation in rent growth for many years. I know some folks out in the Phoenix area and they're getting aggressive with their acquisitions over the last few years. The rent growth has completely come to a stop. And so they're banking, underwriting for, big rent growth for this to continue. And then it came to a stop with all the new build, all the new supply. Because in those markets that have the crazy rent growth, there's also a lot of new supply because that's where all the builders are going. And then those buildings get up and it affects, a lot of the rent growth. And so I don't know. I think for me, there's a lot of reasons why I like the Cincinnati market. I mean, we talked about the population growth. We talked about the employment growth. I feel like for a Midwest market, I think from an aesthetic standpoint, like the vibe is pretty cool. Like you got the Ohio River right there. You got the downtown area. There's hills. There's a lot of greenery. Like there's a lot of cool things to do. A lot of gentrifying areas. I like the Cincinnati area. Give me some reasons why someone should go and invest in Cincinnati. What do you like about the area?
Yeah, like I said, it's safe. So even in bad times, you're going to be able to weather the storm because you do have that cushion based on where cap rates are in Cincinnati relative to some hotter primary markets. So it's safe. Our economy isn't dependent on any one industry. So we've got 8 Fortune 500 companies, got a lot of diversity there. So, we've got everything you could want out of.
Who is some of the bigger companies out there?
You got Kroger, Fifth Third, Western and Southern, Great American. So, healthcare is great there too. Cincinnati Children's Hospital.
Yeah, a lot of hospitals out there.
A lot of hospitals.
A lot of good universities.
University of Cincinnati is over 50,000 enrollment now and still growing. So, Cincy's got a lot of good things happening.
Kroger's big. I think if you're going into, especially these Midwest markets, I think the two biggest levers you got to look at from like a fundamentals macros perspective are like above average employment growth. Like for example, you go to a high cap rate market like Cleveland or Detroit or Pittsburgh, they have below average. I mean, like look at the population growth, negative population growth in areas like Detroit, Cleveland, and Pittsburgh. That kind of scares me personally. Because if you just think about it from like a very basic level, more people are leaving than coming. It's going to drive real estate prices down. Because at the end of the day, it's all supply and demand. And that's the game that we're playing. But also, I think the cool thing about Cincinnati, which is I don't hear many people talking about, is certain markets have a larger supply of like smaller apartment buildings, and some of them just don't have a large supply of smaller apartment buildings. San Diego does have a large amount of them, but Cincinnati, I would say there's a ton of like 8 to like, you know, 15 unit buildings. A lot of these like 10 plexes. Like it's very, very common. You just drive up and down a lot of these streets and you just see them like one by one. Like I think back in the 50s and 60s, they just developed
Hmm.
a ton of them, right?
Yeah. Yeah. There's a ton of product built in that 50s to 70s. Cincinnati is about 3/4 1970s and older product. So if you're coming to Cincinnati to buy 20, 30-year-old products, it's going to be pretty steep competition. So, but if you're not scared of, older vintage that you can bring back to life, Cincinnati is a great market for that.
Yeah, absolutely. And then talk about the rent growth, because I know when I got in the game in 2019, picked up Carthage, 11 units right there. I think the rents when we closed on that thing were like the one bedrooms were getting like as little as 395, and the two bedrooms were getting like 550.
Yeah.
And now, I mean, the rents have essentially almost doubled
Yeah.
since then.
Yeah. I think we kind of woke up during COVID and our rent growth finally caught up with the rest of the country. So Cincinnati was in the headlines there for a while as the top rent growth in the country. So
Really, top rent growth during COVID.
yeah, for a short time. I don't know for how many months it was, but yeah, they were at the top of the list there for a while. So seems like it was kind of a secret. And then during COVID, people discovered Cincinnati and how low the price per unit was and how affordable it is, and we're not overbuilt either. So right now, there's actually a record amount of units being delivered. There's about 4,900 units under construction, which is about 3.4% of our total inventory, which that 3.4, I believe, is a record amount. But relative to other markets who are developing 5, 6, 8% of their total inventory right now, 3.4% is, I would not consider to be overbuilt. Vacancy right now is spiked up to about 7%, 7.2, I think, but still below the national average.
What are some good neighborhoods to be in the Cincinnati area? Let's say that if you want to go, pick up something that's like a C class type of property, 10 units, 12 unit building, and something that where you can have some value add. Norwood's where I did the first one. What are some good neighborhoods that you like?
Yeah, so Norwood, of course, Pleasant Ridge, Silverton, Kennedy Heights. People seem to love that Montgomery Road corridor there. Very centrally located, just 10 or 15 minutes from downtown, but still kind of that suburban feel. I was reading that Warren County is actually slated for the highest population growth over the next 5 years. So, that's the northeast side of Cincinnati, so more of the suburbs outside the 275 loop. So I think Warren County is a sub-market to keep your eye on over the next few years.
Okay. And then what about on the south side of the river there?
Northern Kentucky has been very hot. New development in Boone and Kenton County. So a lot going on there. The Amazon at the airport. Cincinnati being centrally located within the country, logistics have been a big driver of the economy as of late.
Is the Cincinnati airport now the main hub for Amazon?
One of them, at least. I think the hangar that they have there is one of the top 5 largest buildings in the country. I think they can fit almost 100 747s under roof there.
That's
So,
crazy. So similar to like, FedEx uses Memphis and UPS, I believe, uses what is it, Louisville,
Louisville, yeah.
right? That's cool. And Amazon, that's Amazon, Jeff Bezos. They're just getting warmed up.
Yeah.
Yeah. Okay. And so, talk about the price per doors right now, because when I came in, and that was Norwood, and rents were underperforming in that particular property. We're talking about Carthage. I think it was like 31 a door is what we closed on.
That's crazy to think, but that number does stick out. I think that's
Yeah,
accurate.
31 a door. What are like kind of the comps right now? If you look at a comp set for some of these 10 unit, 12 unit deals that are trading right now, this past year or so, what are the price per doors we're looking at?
Yeah, good question. So one thing to preface this is don't get too hung up on price per door, because there can be a huge variance. Obviously, if you're looking at a building that's all studios versus something that's a combination of 2 and 3 beds, those 2 and 3, 4-bed units can be tricky to sell because people won't always even look at the underwriting when they see the price per door. So, point noted, don't judge a book by its cover based on price per door.
Totally. And I can speak to that. You know, just like the difference between the 11 units in Norwood and the 8 units that you sold me in Covington. That unit mix was primarily a lot of studios, and it was a very cheap price per door as well. But Carthage, a lot of a good mix of 1 and 2 bedrooms, no studios, and that property has performed much better. It's seen a lot of organic rent growth. I think generally speaking, the demographic that it attracts would stay a little bit longer and just much easier asset to manage. And I think it's going to have a nicer exit. Madison, a lot of studios, attracts a certain demographic. I think that one was very, very challenging from like a operation standpoint. And one of the reasons I sold it last year, but still made money on it. But, you know, looking at both, to your point, I think the unit mix is very important when you're looking at price per door.
Mhm. Yeah, so to answer your question, I think in that studio to 1-bed size range, if we're talking C-class, kind of a wide range, but I'm gonna say anywhere between 50 and 70,000 a unit, depending on how much work it might need. Going above that, you know, it's gonna be hard to find a high concentration of 2 beds under 75 or 80 a door. And then if you're talking newer vintage 2 beds, you're gonna be over 100 a door.
hmm Yeah, and I think the cool thing though is like you can come in and pick up something that you know it's underperforming. Maybe there's a lift to be created by renovating some of the units. Loss to lease is another thing. What's loss to lease?
Loss to lease is basically the difference between your average rent and your market rent. So if you're getting 1,000 a month on your 2 beds and your average is only 900, you've got $100 in loss to lease. So it's easy upside when you've already proven out that 1,000 a month rent. So that's it's a
Yeah.
quick explanation there.
Yeah, no, that's easy. And then, you know, some other multifamily like levers that you can pull as a buyer going in, buying underperforming stuff. There's a good amount of levers. You know, one of them is like rubs, right? Talk a little bit about what that is and how you can implement it.
Yeah. So RUB is basically billing back for utilities that the owner is paying for. So in Cincinnati, especially in these older buildings, oftentimes there's a boiler heating system. So the owner is responsible for heat, more often than not water as well. Typically tenants are paying their electric, but what's become popular is billing back, you know, 30, 40, 50 plus dollars in addition to the base rent. So I think it's advantageous because it allows you to advertise a lower market rent, get that renter in the door, and you know no one's going to walk away from an extra $50 fee. So I think it helps put more eyes on your property, but hopefully tenants are also a little bit more responsible, knowing that they're paying for the utilities with not opening the windows in the middle of winter.
Yeah, I agree. And if you just look at, you know, rubs, just in that example, you said, okay, it's like $50 a month as like a utility fee that you're going to charge all the units. And let's just say it's a 12-unit building, $50. It doesn't sound much, but across 12 units, that's an extra $600 a month. But over the course of a year, that's $7,200. And you know, let's just say that we're playing at an 8.5% cap rate. You add another, you know, $100,000 of value there to the property, essentially. I think that's a big lever, and guess what? It's free to implement.
Yeah,
You know,
absolutely.
and there's other states with rubs that like North Carolina, you can't. It's illegal to do rubs. You have to actually go and submeter like all the water. But it's illegal to like bill back for utilities in certain states, which is crazy.
Wow, didn't know that.
Yeah.
Take advantage of it while you can.
Yeah, absolutely. Here in San Diego, it's the norm. Like, there's my old building that I lived in here in Little Italy. It's right across the street. I moved out of there, but I lived there for like 4.5 years. And newer construction, like 2013 high rise, and I'm like, it's kind of mom and pop ran. And I'm like, whoever buys that building is gonna make a lot of money because they're not. There's so many inefficiencies that I've seen. Like they're like the only building in the neighborhood that doesn't charge rubs, and we're talking like 230 units. Rents are like the lowest in the whole, like literally in this whole downtown area for what you get. And so whoever buys that building is gonna have some big levers to
Yeah.
play with.
Absolutely.
If you love real estate investing, passive income, and tax benefits, but don't have the time, my company, Summers Capital, is buying boutique hotels right now. We source the deals, we renovate the properties, and we even handle all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, visit summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show. Okay, so what are some other multifamily levers that you can add value?
I guess I was just thinking about the expense side. Once you underwrite enough deals, you kind of come to understand what a typical water bill should look like per unit. And sometimes I'll see, water bills that are 3 or 4 times what we see on average. And I'm sure they have a leak somewhere, or running toilets, I think, is probably the number one culprit for that. So there's some really easy fixes you can do. I feel like more people are focused on driving rents, when I think a lot of the value add is actually on the expense side.
That's really good.
Being diligent about, like I said, utilities that are out of control.
So give me an example. If you see an apartment building, it's got a lot of like water expenses. How do you go about saving on a lot of those costs?
Yeah, so I think you walk the units and just do an audit and see who's got running toilets, or look for water damage on ceiling, see if there's a leak. But if you see a water bill that's say if it's 1 beds and that water bill is $80-90+ a month, it should be quite a bit lower. There was actually a deal in Norwood where the owner implemented low flow toilets and the more constrictive shower heads, and got his water bill down to like $35 a month per unit.
Really? Wow, that's really good.
Yeah.
That's really good. $35. Wow, that's like yeah, I'm thinking that's for 10 units, that's $350 a month. That's not bad. And then you mentioned the boiler system for the heating. I think that's pretty common out there with the 1950s, 1960s construction. Any savings there with like the heating and cooling?
Boilers, they kind of get a bad rap, but they're a pretty efficient heating system. Now, the obvious disadvantage is the owner has to pay that. So your tenants aren't necessarily being diligent about lowering that heat bill. So, and a lot of times you can't control it by the unit. So, not all tenants like it at the same temperature. So you'll see, tenants cracking their windows in the winter. So that one's a little bit harder to control, but it's very expensive to either replace a boiler or do away with it and install central air, especially if the ductwork isn't there. So oftentimes you're better off kind of just taking one on the chin and getting a new boiler when the one fails.
Sure. Another lift that I think is easy is bringing in some fresh laundry equipment and using like a good third party. I think a lot of those buildings don't have the in-unit washer and dryer, but there's a lot of third parties out there that can put in some nice equipment. They can take care of all the maintenance, replace the equipment as needed. They do all the work collecting all the coins, and they might take a split, 40-50% split. But that's a nice, amenity to, provide for the tenants, and some good, reliable laundry equipment. And, that stuff adds up every 3 months.
Yeah, it does. And, if you're talking about a 12-unit building, in my opinion, I don't think it's worth managing your own equipment. So I would go a third party. But I think the benefit is more having it as an amenity versus, collecting a few quarters every few months.
Yeah, absolutely. Absolutely. Question for you. So like, we're talking people reaching out to you, looking at deals, all that sort of stuff. I'm sure you get tons of people reaching out from all over the country. How do you typically, well, let's frame it this way. If you're a buyer, what is the best way to approach a broker looking to, establish themselves with a little bit of credibility, so the broker will take them seriously? Because at the end of the day, you guys want to know, hey, like, am I going to get paid? Can this person close? Otherwise, you don't have an alignment of interest to spend a lot of time with this buyer, correct?
Right. Yeah. I mean, if you can have your ducks in a row, have specific criteria of what you're looking for, and not criteria that's changing all the time. I understand it changes a little bit, but if you have criteria that you can stick to, and when a deal is presented to you, move quickly, have the funds ready to go. If you don't have the funds ready to go, what is your plan to come up with the equity? What's your timeline? What is your track record of closing? So if you're a first-time buyer, I mean, you don't have a track record to speak of, everyone's, got to earn their stripes somewhere. So if it's your first time buying, I think you just got to do what you say you're going to do. Like I said, there's not a lot of deals to go around. There were only about 70 or 80 deals that closed last year in all the Cincinnati MSAs. So got to cross your T's, dot your I's, and get it to the finish line.
Yeah, and I just want to stress the importance of that, like, because you think about, listing brokers, I think are like, you guys are like the gatekeepers of these deals. You guys been working these sellers for 10, 15, sometimes 20 years, direct mailers, building the relationships, and then now they're finally ready to sell. And that seller that you finally get the listing on might have 3 or 4 other properties that you'll be lined up to get if this one goes well. And so if you bring a buyer to the table that can't perform and you risk getting on a contract, wasting 60 days, 90 days, and then it falls out, now you risk this relationship with this seller, not just for that listing, but all these potential listings that you would have got. And so there's a lot at stake. And so I would totally understand why you wouldn't feel confident bringing a buyer to the table that can't perform, or you question if they have the ability to perform. And so I think if you're a new buyer, and this is the first one, like, leverage like your team, like, hey, I got my property manager set up. They manage all these other assets in the area. They've been doing this for 15 years. Maybe you guys already know the property manager. Maybe partner with someone that's done it for a while. And then even if they're coming in as a minority partner, just to like sign on the loan, help you out, keep you out of like making big mistakes, now you can leverage the experience of your partner. I think that's one way to get in the door, but there's different ways to do it.
Yeah. Yeah. And a lot of people want to go after the 50, 100 plus unit buildings out of the gates, which is great if you can find it. But I think most investors are better suited building a track record of success with smaller deals and gradually work your way up. I mean, these can appreciate pretty quickly, so you can scale up quickly as you've seen yourself.
Dude, and there's
So
nothing wrong with buying a ton of smaller buildings. Like look at John and Mark McGrath. I mean, they've made a ton of money doing that. I know a ton of folks that have built a ton of wealth out here in Southern California, just buying fourplexes. Like, that's just, you can build a lot of wealth doing it. But I think the name of the game is like, pick something and go deep on it.
yeah, there's about 5 times the amount of inventory under 50 units than over 50. So there's going to be naturally less competition. So yeah, don't shy away from buying smaller deals. And
the other thing is this is like, it's, people try to talk big game all the time. Like, oh, I got all these doors. And I'm like, to me, when I hear that, it's just like, yeah, but how much of these properties do you actually own? And you probably have all these partners and investors, and it's like, that's a lot of time, meetings and reporting and a lot of headaches. And so, I mean, I think there's, I tell people all the time, I'm like, even if they're syndicating stuff, I'm like, yo, do it. But also it's important to build your own portfolio where you own 100% of the deals as well. Smaller deals, no partners, no investors. And like, you don't ever have to sell these deals. You're never like tied to refinance and do all this sort of stuff. And you can take a little bit more risk with those types of deals because it's your money and it's not anyone else's money. And so I think there's something to be said about that. And there's nothing wrong with just playing small ball and building your portfolio that way. It's something that a lot of people don't talk about.
yeah, I think the ego comes into play, and it's all about that door count. And if you got, 500 doors that you're making a 3% return on, you're not doing yourself any favors.
Totally. Okay. So, we're talking best ways for a new buyer to reach out to a broker and kind of establish their presence is, one, knowing the market, knowing their search criteria, what's their buy box, what's their ability to buy. So I always say, like, if you have the ability from an equity standpoint to buy up to a $1 million deal, you shouldn't be, telling the broker, hey, I'll look at $4 or $5 million deals. You're just wasting everyone's time at that point. So know your ability to buy. Are you real? Can you close? What's your track record? And then once you establish that, what's the next step?
I'd say executing. Like I said, during due diligence, there's always going to be things that come up that aren't quite as you expected. But I think trying to avoid the petty retrades or asking the seller for a discount, I think is very important. To try to nickel and dime over a few minor defects here and there does more harm than anything. I think your reputation, I would hope, is worth more than that. So I think closing at the contract price is huge in my book. I think if you can build your reputation and then give me as the broker the ability to go to deal number 2 and tell that first deal story to subsequent sellers, I think is very key.
So that's really good. I'm glad you brought that up. Let's talk about the retrade. When is it like knowing when you should retrade and when you shouldn't retrade? What is that line for you?
So I think if it is something that's a surprise that you didn't see on the first tour or from photos, or that was not disclosed to you, and it's got to be substantial. It can't be you know $3, $4, $5,000 repair. I would say, if it's depending on the deal size, of course, but if it's less than, call it 2 or 3% of the contract price, I wouldn't haggle over it too much, especially if there's backup offers in the mix.
Yes.
So
Yeah, I think like knowing where you stand and how competitive the deal is has something to do with it. But I think for me, like it's pretty black or white. For me, I think it's like I always ask the broker or the seller, like before we go into contract, "Hey, is there any expensive due diligence or capex items, anything nearing the end of its life cycle that I should be aware about, any deferred maintenance?" And so if they're like, "Hey, like the roof needs to be replaced," or like all the HVAC systems are like at the end of their cycle, they need to be replaced. Well, then it's like, okay, great, you already knew that going in. And so when you get into the physical due diligence portion and you find out, oh, the roof needs to be replaced, and guess what, the HVAC units all need to be replaced. Like you were already told that was the expectation going in. That's not a reason to retrade. But if you're told, hey, everything's good, and then you find out the roof needs a full replacement and all the HVAC systems need a full replacement, and it's going to cost you $100,000, whatever it is for that property, that's 100% fair game to retrade, in my opinion.
yeah, agreed. And it's the big ticket items: roof, mechanicals, boiler, furnaces, hot water heaters. Parking lot is not.
Yeah.
You should have driven the property.
Yeah.
What is going on in the parking lot. So
Another big one is discovering a water damage in a lot of the rooms, because that stuff adds up quick. The Bodega Bay deal that we just closed on last April, you guys are a part of. That one, we had heavy rains in California leading up to that closing, and they were like pretty much partially closed down the hotel leading up to the closing. They were just like kind of forfeiting, throwing in the flag. And so no one had really walked the property leading up to the closing, and we had record rainfall in California, and it was the week of closing. I remember I was going to be signing loan docs on Wednesday, wiring in funds on a Thursday to close on Friday, and it was like Monday that week, and I was like, we should go walk all those units. And so ended up sending someone up there to walk all the units, and sure enough, we found 6 rooms with like water damage in the ceiling. So we like put the closing on delay. I called the lender. I was like, hey, that was the first person I called the lender. I'm like, hey, for your planning, we're going to delay this. We found some water damage, and of course, they're cool with that. And, they want to make sure that they're funding a deal that, obviously we're doing proper due diligence on. And we ended up getting another discount because of it. And I think that's another great reason for retrade right there, not disclosing water damage. That's a big deal. And water damage, you don't know what you're getting until you peel back the drywall, but a lot of mold remediation, and then a lot of restoration and all that sort of stuff. That stuff's not cheap. So I think that's another big one.
yeah, that's definitely justifiable. And
Yes.
kudos to you for doing that that extra DD a couple days before close.
And it's not just that, but it's like, okay, it's usually a bigger thing. It's like, well, what's causing the water damage? Is there something going on with the roofing that we didn't know about? Is the drainage system not like built correctly? Like you got to figure out what is the root of that, and all that stuff costs money, But anyhow, I think for me, the retrade that's important. Like know when you can retrade or not retrade. Again, if the expectation is set up front that certain things need to be replaced, and then you find out in due diligence certain things need to be replaced, that's not a reason for retrade. And I'm sure that makes you guys look bad if you bring a buyer to the table that's like just retrading every little thing. And I think another tip that I personally like as a buyer is like, if you are going to retrade a few items, like don't discover one item in the beginning of due diligence and then retrade that, and then a week later you discover another item and then have another retrade. Like just get through your due diligence and make a note of all these different things and get all your stuff in order and figure out what these things are going to cost you, get bids for the repairs. And then at the end of due diligence, figure out what you're going to retrade, what those items are going to cost, and then go to the broker, go to the seller with just one list to retrade and just one ask. And at the end of the at the end of the due diligence, most due diligence periods, I'd say like generally speaking about 30 days. Would you agree?
Yeah. Yep. 30 days
30
DD is pretty
days.
standard.
So like you're going to have more leverage as a buyer, like on day 30, when you're like, hey, this is the last day of our due diligence. We're going to remove contingencies. We have our debt lined up. We can close. We have the equity lined up. We can close in like 3 weeks. But this is like just one thing that we need.
Yeah.
You're much more likely to get a seller to participate with your needs list versus going in week one and saying, hey, I got all this stuff, and just beating them up from the beginning. And they've consumed less time. You're further from the closing table. Everyone's trying to get, paid. And so I like just going in with one simple retrade at the end if it's warranted.
Yeah. Get it all done at once at the end and be ready to make money non-refundable, or at least remove, physical inspection contingency, and be ready for next steps.
I got a question for you because this comes up a lot as a broker. Do you guys, how often are you guys asking buyers for like proof of funds and track record and all that sort of thing? Because I got to be honest, I've never once been asked for proof of funds, but I do get people to come up to me all the time like, hey, like I've been asked for proof of funds. Like, what do I do? Da 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 da. And I'm like, well, it's probably because you're not able to spit the lingo and they just don't trust you.
Yeah. It's not common to ask for proof of funds, but if, especially with how popular syndication has become, right? Not everyone has all the money ready to go day one. So we know there's going to be that capital raise during the escrow period, but, it's pretty rare. But on a competitive deal, if you're trying to set yourself apart, never hurts to submit proof of funds. So not always necessary, but never a bad tool to keep in your back pocket.
Yeah. And then what about like lending? Are you typically calling their lender to like make sure that's good, or what do you want to see there?
Yeah, we get as far as we can with the lender prior to even entering contract. There's only so much you can do. It's not like it's been through underwriting, with the lender yet, but working with a lender that we know and trust is key. If it's a new lender, certainly want to have a more in-depth conversation with them about how they're underwriting the deal, based on their initial reviews. So the more box we can check up front, the better, to increase our chances of close and not wasting 30 or 60 days of everybody's time.
Yeah. I think as a buyer, it's nice to get that LOI from the lender, an official term sheet saying, hey, like, pending the appraisal and some due diligence items, like we're good with these terms, and there'll be like a loan amount, interest rate, terms, and all that, and you can sign it, pay the app fee, get the appraisal ordered. I know at least for me as a buyer, like that's a nice win. Just knowing, hey, like we got some pretty decent terms. The lenders willing to do this deal. And it's just like one more part of the escrow process that you can kind of check the box on. Let's talk about leading up to closing, and let's just say, hey, the buyer needs an extension. Typically, what do you see in there on your end? Do you like the buyer to typically forfeit some more EMD, and how do you approach the seller there?
Yeah, so it's pretty rare to get a free extension. If the seller is being asked to delay close, obviously that becomes a huge red flag. So they want more surety of close. They want to know, there's no more surprises. So if it's really a matter of the bank just needing 2 or 3 more weeks, then put another 10 or 20K non-refundable. So I, as the seller, have confidence that it's still closing.
Yeah, I think that's totally justifiable. And in all reality, like for me as a buyer, if I know I'm gonna perform and I just need a little bit more time, I have no problem throwing in some more non-refundable EMD, because at the end of the day, once you close, that's a credit towards your close. It's less money that you got to send in. So it's essentially, to me, it's not really a cost. And if you really need more time for whatever it is, it's not a big deal to me. But if I don't know I'm for sure going to close, then that is a sunken cost.
Yeah.
Yeah.
If it's typically, if it's just a bank delay, it's not too big of an issue. But I think it's when maybe all the equity isn't raised yet that it becomes more of a concern, especially for the seller. So
Yes.
yeah, I would expect to pay some additional hard money if asking for an extension for any reason.
Totally. So let's talk about the sales side. So as a seller, coming to you, looking to sell their multifamily deal, Typically, you might talk to a couple brokers and get a broker's opinion of value, a BOV. Talk about the BOV. What are you guys looking at when a seller hits you up to do a broker's opinion of value?
Yeah. So my business partner, Sean, being an appraiser and MAI designated appraiser, it's in his DNA to underwrite to fair market value. So that's what we do, and we're not going to overprice something to try to win a listing. We don't feel that's good business practice. So likely, if a seller's getting 3 or 4 BOVs, it's unlikely that we're going to be the highest valuation.
That's a good
So
selling point to get the listing.
yeah. So it's we try to be as realistic as possible versus building a reputation of those are the guys that overprice everything by 15-20%. So from an underwriting standpoint, we're looking at what is the upside. That's why most people invest in multifamily. It's controllable. You can quickly increase the value. So we do an in-depth rent study to understand how far the rents can be pushed relative to the other rent comps in the neighborhood. And then we're looking at, where are some of these expenses maybe a little bit inflated? Where can we cut cost to show a pro forma NOI, if you will?
Yeah, I like that. Are there a lot of brokers? Because I do see it a little bit, but what percentage of brokers that are, especially if they know it's competitive, and the seller's like, hey, I'm just so you know, I'm getting 4 different brokers to give me their opinion. How common is it for a broker to just give them like a higher price just to get the listing, and then they figure, hey, we can
I would
reduce the
say
price
it's fairly
later?
common. I mean, there's a few brokers in town. I won't say any names, but they're typically the highest valuation, and I think it's over time come back to bite them a little bit. So yeah, I think we're trying to take the long game approach, and hopefully our clients respect it in the long run.
Yeah, when we sold the property up in Indianapolis, is the 32-unit building that I mentioned earlier in the show, 3.7 cap rate. No intentions to sell that building, but there was a larger building next door. So this one was 32 units, and directly next door, we almost shared the same driveway, was a 200 and something unit building. And I had been kind of networking with the brokers. I remember I had flown out there, and we had linked up, but I had done like Cincinnati, Louisville, Indianapolis, and they were one of the top brokers out in the Indy area. A lot of deal flow and a lot of transaction volume, but larger assets. And I was speaking to them, and they're like, yeah, we have a buyer under contract on the property directly next door. It's some outrageous number. It was like 100 and something a door. And this is, again, 1960s C-class product. And he was like, I could get you the same thing for your property. And shoot, maybe this buyer would want to buy yours as well. And so we ended up moving forward with them. And that buyer didn't end up buying that property, but we got the similar number they thought it'd be worth. And so I don't know. It was interesting. They said we were renovating all the units, and we were about 50% done. And they said, stop renovating the units, because at this time the market was so crazy. Like, people will pay more right now for unrenovated units than they will renovated units. So like, just stop renovating.
Yeah, it's crazy, and that's why it's such a fine line and balancing act, because maybe there is that buyer out there that's really hungry and they're looking for more scale in that area, and they got 1031 money and a huge tax bill staring them down. So we try not to price based on that needle in a haystack type buyer, though. We want to show a value that the majority of the market is willing to pay, and create a competitive bidding environment. We want to bring you 5, 10, 15 offers, not 1 or 2 offers, so that you can see where the market is coming in.
Yeah, absolutely. And I think for the folks out there that say like, oh, like, these high cap rate markets like the Midwest, like there's no appreciation. I think that's a myth. I think if you buy the right asset at a low basis, you add value. I think that you can enforce a lot of appreciation. So like that Indy property, we bought it for 1.1, 2 years later, sold it for 3.1. We almost tripled the value in a market where people say, oh, there's no appreciation. Sorry, what was that? Carthage that you sold me, bought that for, I think it was 350 back in 2019. We'll sell it for 800.
Mm-hmm.
So that's more than double.
Yeah.
And so like, you can force appreciation out there. There is appreciation. You just got to buy right and have some value add strategies. And I think you can do well.
Yeah. I remember the days of 100K a unit, I feel like it's become like a psychological barrier because it hasn't been common in Cincinnati. Now it's becoming more common, and there's just so much sticker shock once we hit 100 a door. But that's why you got to look at the NOI.
Yeah, absolutely. What's the biggest mistake that you see newer multifamily investors making?
It's a good question. I would say overanalyzing, like you kind of spoke to with your Carthage purchase. You kind of dove in head first. You didn't know exactly what you were getting yourself into, but you're getting it at a price where you can afford to make a few mistakes and learn along the way. So don't feel you've got to hit a home run on your first purchase. There's nothing wrong with hitting a single and gaining that experience and track record. So if you wait around forever trying to hit a home run, you could have hit 10 or 20 singles by that time.
That's good. No one retires off of their first deal as a real estate investor.
Yeah,
No one.
absolutely.
And you're right. I didn't. All I knew with that deal, and I had been I had been educating myself a lot, but all I knew with that deal, I was like, I'm buying an 11-unit building for $350,000. I'm like, how could I lose there?
Yeah.
And so, yeah, I just did it. And actually, the crazy part is I bought that like sight unseen.
Yeah.
I didn't even fly out there to walk it. But I had you, and I leveraged you to do all that sort of stuff. And I felt like, you can do a lot of your due diligence online these days. And I bought that one sight unseen. And now I've seen it, and it worked out.
It's still standing.
It's still standing. It worked out. Right property manager in place. Initially had the wrong one, and I think that's another big thing is like the third party property manager that you use is so important, especially if you're like investing out of state. It's very, very important. I know with the Indy property that we had up there, like it was a lot more hands on. I know with the Madison deal, that was a little bit more hands on. And honestly, I don't have time to be hands on with some of that stuff right now. And so I appreciate a good manager to where you don't have to babysit them, if you will.
Yeah. Yeah. And unfortunately, maybe it takes, trying 2 to 3 different property managers before you find the right fit. So do as much homework as you can and figure out who you think is the best fit, but you never really know until they start managing for you and you have that working relationship.
Yep, absolutely. JD, appreciate you coming on the show, my man. Where can the folks learn more, get in touch with you if they want to get in the multifamily game, get in touch with you, and maybe find some assets out there in Cincinnati?
Let's set up a call, phone call or email. Let's understand your criteria and get to know one another and do some deals here.
What's the best way to get in touch with you?
We'll say call or text to set up a call.
Okay. Phone number?
513-739-0058.
There it is. Hey, and we'll drop contact information, email, website, all that good stuff in the show notes as well. JD, appreciate you, man. Big fan of everything you're doing, and I can't thank you enough for everything. You got me in the game, and it all starts with just that one deal, man.
Right on. Thank
Yeah.
you.
Yeah,
Appreciate it,
appreciate
Rich.
you. He's JD Schmerge. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you guys on the next one. Peace.